This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Steve Saretsky here. Welcome back to the show. We got lots to touch on this week. We got an update from the Bank of Canada. We got some update in the mortgage market. We have update on national housing statistics, national figures. Going to walk you through the data, but also through the anecdotes. Going to cut through a lot of the noise, a lot of the BS that's being spewed out in the market. There's a lot of confusion as to what's happening in the housing market. So I'm going to try to clarify a lot of that for you here today. But we have to frame this week's episode up with a lot of what we've chatted about over the past few weeks, right? Which is there's a narrative building. The narrative that's been building is, listen, Bank of Canada's come out and said they're pausing rates. The rate hiking cycle is done. Housing is starting to pick up. We're starting to see multiple offers again. This is probably the bottom of the housing market. We're going to get a couple rate hikes later this year, and that's going to sort of ignite the next housing bull market. And so I've really been pushing back against that narrative on the premise that, listen, guys, if housing actually materially picks up, gains momentum, it prompts the Bank of Canada to have to hold rates higher for longer. So why would you start cutting if housing, which is, more than 30% of the shelter, which is, shelter is over 30% of the CPI basket. If that starts accelerating, I struggle to think that the Bank of Canada is going to start cutting rates. And so, sure enough, we've seen in the last week or so, we've seen data that's been coming in more optimistic. It turns out the economy is holding up better. We're not losing that many jobs. We're seeing some economic indicators starting to rebound. And so all of a sudden, the bond market's going, oh, okay, maybe the Bank of Canada won't cut rates this year. And now we're seeing bond yields actually moving higher on the premise that rates will, in fact, have to go higher. So the all-important Canada 5-year bond yield is up 60 basis points from about 3-4 weeks ago. Now, you remember, and I was out here saying that too, guys, listen, if we had the Canada 5-year bond yield at about 2.8%, that suggested that if it held, you would have had mortgage rates, 5-year mortgage rates in the low 4s, probably by later in the spring market. So you can certainly make an argument that would have been positive for the housing market. But again, if the data changes, you got to be willing to change with the data with it. I mean, your views should change if the facts change. And so the facts have changed. The Canada 5-year bond's up 60 basis points. The rate cuts that we were seeing in the mortgage market are now going back up. So you're going to see every mortgage rate's now going to have a 5 handle back in front of it. Your variable's still in the mid 6s. So it's getting harder to put the bull thesis together, given what is playing out in the markets, in what's happening in financial conditions. So that's something I want you to understand as we walk through the data. Now, keep in mind, we've got some national housing statistics out this month, for the month of January. This data, again, it's not forward-looking. It kind of tells us what's already happened, but I think it's important to sort of dissect it because it's going to bring us to our next conversation, which is, so the national housing statistics come out. You have national home sales down 37% year over year, one of the worst Januaries in the last decade. And national house prices on a year over year basis are down 12.8% as per the home price index. That's the largest move since the index was created in 2005. Again, that's year over year, because if you're comparing it to last January of 2022, that was basically very close to the blow off top. So huge base effect there. But if you actually look at the home price index now peak to trough, we're down 18% peak to trough. So this has been a historic national housing correction to date. If this was just completely the end, this will register as the largest correction that Canadians have seen in 2 decades. So now, again, the question is, has it ended and has it not ended? We're about to find out. What is ultimately underpinning the housing market right now is new listings. Yeah, I've talked about it on the show before, whether you're in Vancouver, whether you're in Toronto, nationally. National, across the nation in Canada, new listings are running at their lowest levels since January of 2000. So you have a 23-year low in new listings. The number of new listings coming to the market. Now, again, let's factor in how much our population has grown over those 20 years. And you can say that's pretty obscene. Now, this is not just a Canadian story. If you look into the US, inventories at the lowest levels, I think, in 2 decades. So something is happening. I don't know necessarily what's prompting people not to list their houses. There was a great chart that was put out the other day that showed that owner-occupied housing in the city of Vancouver, 50% of them, 50% are in fact mortgage, debt-free. No HELOCs, no mortgages, debt-free. Now, obviously, the investment properties aren't accounted, and those are the ones that are levered up. But if you're individual homeowner, 50% in the city of Vancouver are debt-free. So they look at this market conditions and say, well, I might want to move, but there's no inventory on the market for me to buy. So I don't want to put my house up on the market and be homeless and have to go and rent or stay in a hotel because I can't find anything to buy. So people are just staying put. They're not moving. And so I don't know, at some point this log jam has to come unglued and has to change. The wave of foreclosures, the wave of people rushing to sell because rates are up and prices were falling has not materialized. It simply has not materialized. It may materialize. We know that there's stress building up, as one would expect when interest rates move up by 425 basis points in a span of 12 months. It makes sense that stress will start to build. I mean, there was a reason the Bank of Canada hit the pause button. It wasn't because CPI inflation is well on its path to 2%. It's because household debt is egregiously high in this nation. In fact, household debt to disposable income has skyrocketed off of the charts. And this is the chart that ultimately has the Bank of Canada concerned, because the longer that they can hold rates here, the more ultimate pain I think will have to filter through into households. And so now talking about this situation where if inflation is proving sticky, are we in the situation for, again, higher for longer? I think the higher for longer that we are, the more pain on households, and I think the more issues the housing market is going to face. And so that is ultimately the question. And I don't have a strong reading on inflation. All I know is that I think people were getting ahead of themselves when Bank of Canada waved the flag saying that we're done for now. Because again, if the housing market takes off, when the housing market equates for 30+% of the CPI basket, it becomes inflationary. So everything else better completely fall off to offset those inflationary impacts. So that's what we're seeing in this nation's housing market. Anecdotally, on the boots on the ground, what I can tell you is happening is that if you're looking for an entry-level single-family detached house, which is like most families in this country trying to squeeze into an entry-level detached house, is competitive. You're most likely going to be competing in multiple offers on a lot of product. Yeah, there's a lot of product that's completely overpriced, still priced at February 2022 levels, and it's just sitting there for 3-4 months now. But the product that comes to market that's priced where it realistically should be is competitive. It's getting 30, 40 groups through their open houses. 30, 40 groups. I wasn't even getting 30, 40 groups in the top of the bull market back in February of 2022. So people are out there looking. It's bizarre. It's crazy because 7, 8, 9, 10 weeks ago, that wasn't the case. So something has changed. And again, I don't know if everyone's paying attention to the Bank of Canada, because I don't think most Canadians know who Tiff Macklem even is. So there's maybe this built up lust for housing. I don't know the answer, but basically, and the reason people are competing on housing is because you have 20-year lows in new listings. There's no inventory. And the reality today is on a lot of product, not all product, but especially, let's say, entry-level detached houses, if you're buying in Vancouver, if you're buying in Toronto right now, you're paying more today than you would have paid 6, 8, 12, 15 weeks ago. You're paying more today. So I know it's a little bit too soon to say, hey, prices are going up, but you're paying more today. There were better deals 2, 3, 4 months ago in this nation's housing market for the most part. So that's fascinating. I find that very, very interesting. And again, that's the part of the puzzle. That is the underlying demand actually that strong though, or is it just because there's no inventory? So will the inventory problem get solved? If it does, how quickly will it take to get solved? By the time it does get solved, where are mortgage rates? I mean, this is why I think it really is a fool's game at this point to try to predict where the market's going to be 8, 10, 12 months out. All I know is that we've got a debt problem. We've got extremely high interest rates that are going to start to bite. So the course is, how long do rates stay this high? And at what point do the inventory levels figure it out? I continue to be amazed. I can tell you, I think the first to leak it, that the major developer in Vancouver had gone bust on $1 billion of land holdings. There's more. I can tell you there is more. There's another name that's I don't know if it'll make the public papers, but if you're in the real estate industry, I'm sure you'll find out about it in the next 4 to 6 weeks. So you're seeing some of these like larger defaults. You're seeing some of the issues that are happening in that space, and yet you've got like multiple offers happening on the residential retail side. Very, very fascinating market, but ultimately pretty hard to get price discovery. This is the issue that people are having, not only today in the residential real estate market. Very low sales we have right now, very low sales, but yet very low new listings. So just not a lot of transactions in general. Hard to figure out what things are worth when there's not a lot of turnover. And that's the same thing that's happening out more or less in the commercial side. So you look at these developers that are holding these land parcels, and they're running into liquidity issues because a lot of lenders don't want to refinance them, or if they refinance them, they say, well, you got to put more money into the deal because we think land values have fallen. We don't know how much they've fallen because there's really not a lot of transactions. It's a pretty liquid market in that space, but we think it's fallen, and we're only comfortable lending this loan to value. So if you want a mortgage, if you want a new loan, you got to put this equity in. And a lot of these developers are saying, well, I don't have that much equity. Where am I going to pull that equity from? I got to sell something. Well, I can't sell anything because the market's fairly illiquid. And it's pretty tough to raise money in this environment. So these are the issues that we're having. So we're kind of going through, we're at the beginnings, I think, of this default cycle. Yet the residential side continues to be kind of stuck in no man's land due to the lack of sales and new listings. So, I mean, ultimately, hey, if you're a realtor like myself, actually a pretty crappy market. Because you don't really have a whole lot to list. You don't really have a whole lot to sell. And the stuff that you're actually taking buyers out to, you're actually competing in a lot of this product because everybody else is showing up to the same open house because there's one listing a week. So again, really fascinating market, boots on the ground. We'll continue to monitor this thing. Like I said, the thing that I like to hit refresh on every week is the Canada 5-year bond yield, because that's going to tell you much of the story here moving forward. Based on the direction of that, we'll get Canada's CPI inflation print on Tuesday. I believe it's Tuesday this coming week. That should move the 5-year bond yield around quite a bit. So we'll watch for that print this week. As always, hope that helped, and we'll see you next week.